Welcome everyone. Hope you had a great New Year's celebration. This is another edition of our Monday market update. No Sean Grapevine this week. We got Rob Pieklo in studio. He's a master of originating. He's a master of capital markets, front to back, secondary, primary, you name it. He's our man, and happy he's joining us for another week here.
Yeah,
Thanks for taking the
I
time.
feel bad for the audience that Sean's not here because we know that he brings a vibe. He brings a vibe to the market update. But we're excited to have him back next week, and he'll run the show and get to talk about some fun stuff that we had the last month or so. Austin, like let's get right into it, man. It's 2022 is gone. 2023 is here. We did our outlook. Of what we thought the year was going to end like. Let's start talking about what we think is important to start 2023. So give us a little bit of the insight from you, your knowledge base of what you're seeing out there. What are some things that the originating team here can look to and kind of feed off of what's going to kick off 2023?
Yeah, I think we have a lot of themes we touched on even last week, but I think a lot of things hold true. Is We have a big year ahead of us in terms of, um, you know, we always talk about the Fed, but that's a very important topic. What does the Fed do in this year? How many rate increases do we have? Do we have any decreases? What does the economy, how well does the economy fare, over this year? Because if you look at the news, a lot of times we'll see predictions of maybe a mild recession, maybe a recession that's avoided, a soft landing per se, and or just there's a housing crash. There's people that are bullish, there's people that are very bearish. It's a year that will be kind of like the truth serum. What's really probably going to happen after the policies we've gone through, whether it was 2021, 2020, where we had very easy money, to a very tightening, monetary policy that we've all experienced, all too well. So I think this is a big year for that. Also, FHFA, making a lot of big changes. I think, with the affordable mortgages becoming, a big point that they're trying to focus on. How does, maybe credit appetite in the private label world, try to fill that gap? That's something that I think could be very interesting to take a look at, as well as just how far do rates go down if we do have them go down a fair amount this year. Is there going to be a fair amount of refis or not? I think that's another thing that we are all looking forward to. But at the same time, it's pretty impossible to put a number on it. And I think that is very clear. It's hard to put a number on anything, as our like year end prediction thing told us. But we'll allude to that a little bit later. But I mean, yeah, I think those are some of the big themes. But there's so many things to think about. How does the housing market fare, as well as I think a very important part. And just what supply and demand dynamics continue to go out there. I think everyone thinks about affordability, and there's really two things you can kind of play with there, and that's the price and the cost of the mortgage itself, and what kind of toggles are we playing with here to make things more affordable, or is it just continued strength in demand? Who knows what's going to be.
Yeah, so I think a couple points I want to touch on there because it's super important. And affordability, that's right where I was going, where everybody's concerned about affordability, yet we're not seeing movement in the government agencies to make things more affordable. We have MMI fund is at the highest level it's ever been in preparation. Now they're saying it's in preparation for potentially a downturn in the markets, and but they haven't made a move on FHA insurance yet with the MMI fund. So you see that the actions are not there. Everyone's talking about affordability, what they can do. They have actionable items they can do right now today through Congress, and everybody's kind of waiting for it, but they're just not doing it. And then FHFA and running the GSEs continues to stick to their statement of not being somebody to subsidize second homes and investment properties. Now cash outs are getting larger hits. So PLS this might be the year where we can see pricing go through what the government is charging, and people with really good credit and in certain aspects of good LTV and good income may choose to go the route of PLS. As you stare at some of the jumbo products that are out there, pricing a little bit better than the conventional products, is that going to continue? And the more LLPAs and more G fee increases we see this year, PLS can make a big comeback this year for like standard product, which we have not seen in 10 plus years.
No question. And I think one thing, you know, the market, the PLS side is just so disjointed right now. It's just there's a lot of people on the sideline with a lot of dry powder, I'd say, just kind of waiting for the opportunity to jump in. I think the tricky part about PLS is it's multifaceted. There's so many different steps, because the loan doesn't just find its final home once you get the closing, doc sign at the closing table. There's so many things after the fact that create this lag, and that's what we saw that drama with earlier last year. It's going to take some time to heal, but I really hope that the PLS market does find a niche to go after. They kind of did in 2020, and with the investment, non-owner ocs and everything like that, and even before then, non-owner ocs were kind of something that was picking up steam. I think that's something that we can, hopefully see again, but we'll see. We'll see what happens.
Yeah, I agree wholeheartedly there. And then it's the government actions that are really important for this. Now we know there's the market, and then we have these things that we actually have control over. So again, FHFA, what they're putting in place, and kind of how much pull they actually have for what this market's going to look like. It's pretty crazy. But we do know one thing: affordable housing initiatives are there. It looks like the spec pay up world, where loans that have a better chance of staying on the books for a longer period of time, that aren't going to prepay that fast. That we know that that market has come roaring back as of late, especially in these higher coupons. So there's a lot of market activity now that we want to pay attention to, and we're starting to see that varying from lender to lender and varying from the delivery method from these lenders as well. So that's kind of a lot going on in terms of the government involvement in mortgages in general. Now, market stuff. We know that Friday's a big day. We have jobs report coming in. It's kind of been what the Fed has hung their hat on in terms of why they're raising rates so quickly, at the velocity that they've been doing it, and why it's going to continue. So they've been hanging their hat on the jobs numbers and what they're seeing there, and then we have I think CPI is coming out mid-month. I think it's January. I think it's like January 12th or so, and that comes out. So those are the two kind of big data points that we see in the next couple of weeks, right?
100%, and that's what all the fixed income traders on Wall Street are looking at, right? That's the big thing on their calendar, because really we're all playing the Fed's ballpark here, and how these numbers go can influence what they even say. Maybe not what they do actually on the decision, but it is a lot about what they say, or what they say they will do in the future, and kind of how they interpret this data. So the market, it reacts real time, and they wait for kind of reconfirmation from the Fed, I guess, of their directions. And those have also been disjointed. We've seen that happen too. So I think if we see weaker job numbers, we see a pretty interesting rate reaction, and how much it goes back the other way. Maybe rates go down, or if they stay flat, or they are actually the hot jobs number, which would seem hard to believe, but it could happen possibly. That would make rates, I think, continue to stay elevated. We've seen, obviously, from the lows of last year, like at last Q4, we've seen rates go up. How sticky are they up here is going to be kind of something that we'll find out with the data that we get, as well as just other international economic activities that are just go beyond some of our own understandings, or kind of our own radars, I guess you could say. That could also influence a lot of this, movement of rate. But at the end of the day, these are the big things that we have to pay attention to, and I think Friday is going to be a big one.
Yeah, I think the job side, it's hard. Being in the mortgage business, you couldn't even wrap your head around there being significant job gains, right? We're in the business where unfortunately you kind of scroll through LinkedIn, and you see a significant amount of people being laid off, or have been laid off, and are having a tough time getting a job. And it's pretty crazy to see that for our industry. We had obviously $4.4 trillion market shrunk down to what might be 2 trillion, might be 1.6 trillion, some estimates down to 1.3 trillion. So we'll see what the year brings, but I guess other sectors are gaining steam, or doing something in terms of services. And I don't know, you go to a restaurant, it seems pretty busy still. Like there's a lot of stuff going on in the economy that we want to pay attention to, but the jobs report is kind of what they've been hanging their hat on in terms of these hikes. So we'll see what that looks like. We'll see what CPI looks like, and then that'll set the tone for the entire year, I think, or at least for the first few months. The mortgage industry is looking, potentially for some reaction to make rates move down just a little bit. We saw this melt up towards the end of the year, which I got wrong. We're going to talk about that in a second. But I was expecting a slow meltdown, but it was a melt up. In terms of rates, we saw that go, and it looked like some pent up demand today. If you're staring at the screens today, lots of green when it comes to rates. So you're seeing probably pricing improve by 50 or 60 basis points in some scenarios. So you are seeing that today. People are getting into fixed income today. Now, the mortgage industry this quarter, they're looking for just to move down a little bit, kind of where we were, where we saw some pickup in applications. When you start with the 5 handle on rates, that's really, like, a really important psychological number for people to want to get back in or jump off the fence and get into the house purchase game, whether it's a primary or investment, or whichever type of product they may be buying. So so that's the big deal right now. It's going to set the tone. And we really want to see, we'd like to see rates just come down just a tiny bit, because we are running into those scenarios again where the market isn't allowing, basically it's not rates getting worse, it's just pricing getting worse. So we talked about that before, the formation of higher coupons, formation of bonds that allow more premium to be able to do that. But in this market, with all this news going back and forth, it's hard to kind of set a market in price without, the inevitable refinance that's coming, because I think everybody's kind of been prepping and ready for that, and they expect that to come down based on some of the analysts that are out there. They expect rates to come down in the next 6 months or 9 months to be able to do that. So it's hard to kind of set a market at those higher coupons and price enough to be able to cover these LLPAs and other margin requirements our lenders have.
100%. And I think everyone, the seat we have to sit in sometimes, they like as the originators is almost as the investors, right? Because the reason why we have a mortgage market that's this fluid is because there's investors, and those investors come in a lot of different shapes and sizes, and they could be a foreign Japanese national bank, or it could be some your retirement fund that your 401k is invested in, but whoever they are buying MBS. But everyone understands pool to par, and they understand, hey, if I give a mortgage out at 102 cents on the dollar and they pay off their mortgage in 2 months, I only get 100 cents on the dollar. They just give me the cash. It's not a good economics to provide tons of premium up at these higher rates if things are going to refi in the short future. So I think everyone's kind of understanding that, but volatility just never is good. We kind of need consistent production. So hopefully we can kind of find a nice coupon or two that we can kind of deliver to, that actually seems sustainable. So I think that's 100% right, Rob. And I'm looking forward to seeing how this week and really this month goes. But I think this week will be kind of big. And like you said, big pent up demand, melt up at the end of the year. I think that was a lot of the 2 to 10s were way too inverted, but we don't want to get too technical on this thing.
Yeah, so let's talk about that. We obviously we ran a contest internally. I'm excited to go over the numbers. We'll do that next week. We're going to be announcing our individual winners. We're going to be announcing that Austin might have kicked my butt in that one as well, and he's going to get some cheesesteaks for him and his team. But we're not going to release it just yet. We're going to just review the numbers, make sure we're right on that, and let Sean do that kind of reveal next week. Excited to announce those winners, like I said, and they're going to get their gift. I'm excited to see what the gift is. Sean was talking it up, so we have to figure that. We'll probably have a separate chat, trying to make sure that the gift lives up, or the award is going to live up to the expectations that Sean set for it. So excited for that. And we wanted to make this obviously pretty short today, because there's just not much information that has come out since our last market update. We had a real quiet, like I said, melt up last week. We're looking to kind of hit the ground running here in 2023, and seeing, I'm looking at the screens and seeing significant activity in the bond market. So that's a positive. At least day one, it looks pretty good. We'll see how this pans out for the rest of the week here as we go through and we hit Friday. Friday again is going to be a big day, and we'd expect to see some volatility going in, probably just before the numbers are released. And then Friday itself is always a pretty, hate that Friday kind of panic and volatility pricing that the desk did. I know I did back in the day. Rate sheets, these kinds of days, you never liked it when there was a potential for a significant move, and then those moves happen, and you might have been on the wrong side of it, or you might have just kind of stayed flat, and you end up on the wrong side of it because of a massive move. So usually you see, price sheets end up being a little bit, let's say a little bit more margin in it to help protect against some significant moves that occur during volatile days. So we'll see what that looks like. We'll kind of close out here, and Austin, just ask you anything else you want to bring up to the team members here, and kind of talk about anything else we should be looking out for in the next week.
No, I think Robbie did a great job covering what I think we had on the docket today. Just looking forward to work with everyone in new year, obviously, but we got a lot of great things coming up here, and just keep up the hard work, and we'll all get through this together. We're all operating in the same market. So
yeah, I think loans matter, right? Like that's the nice part is having loans and having ability to work with our lending partners and get really good pricing and kind of push forward. It's really hard to do it when you say, give me the best pricing you can, and then we'll give you loans. It's nice to have the loans and seeing these team members really go out and crush it, get the loans in. Then we can start working with our lending partners to figure out what avenue can we go to get the best price. It always works a lot easier with loans than it is to ask for something without the loan. So we'll get working on that to get the best pricing for our originators out there.
That's right, 100% right. All right, well, thanks, Rob. This will do it for us today, and I hope you guys have a great rest of your week. And tune in for Friday, see what we got for the jobs number. Hopefully something good. We'll see.
Awesome. Thanks, Austin.
Of course. See ya.